Hello everyone and welcome back to another episode. I'm your host, the Millennial Investor, and in today's video we are going to be talking about JP Chase. It is one of the largest holdings in my portfolio, currently making up about 5%, and not only is it one of the largest holdings, but it's also one of my best performers. On a money-weighted return, we are currently up 114% on this company. On a time-weighted return, which is probably a bit more accurate from the time I bought these shares, JP Morgan, I'm currently up 56% from my average share price where I bought it at. Because I own JP Morgan at an average price of $98. And if we go to JPM stock, it currently trades at today's price at $154 a share. So over 50% higher from my average share price, which is way down here. So I made a lot of my purchases in early and mid and late 2020. And then so far for the last 3, 4, 5 months, this company is just skyrocketed in price. And we're going to go over why one of those and we're going to go over some of the main reasons why that is, why it's up here again today, another 1%. And part of that reason is because of the news that was just announced yesterday. We're going to be talking about how this will affect JP Morgan, as well as other big bank stocks alike. And then we're going to go over some other things as well, including things like share buybacks for the company. We're going to talk about the dividend policy and what that will look like moving forward. We're going to talk about profit margins, something that I usually don't talk about very often, but with JP Morgan, the profit margins are incredible. I want to talk about what this business model is just so great and why it's, in my opinion, the best financials company on earth. And also we'll talk about other things about why JP Morgan is going to be just fine going into the next 10 years, going into the 2020s, right? And this company will be able to compete with the big competitors, the big fintech companies that you all are worried about, like your Chime banks and your Square and your PayPal and your whatever. I think JP Morgan is going to do just fine. But before we get into all of that, my name is Jordan. I'm the Millennial Investor. If you haven't watched me before, I track my annual and monthly dividend income through these two charts right here that I'm hovering over, and these are the companies that I currently own, which is in column A, highlighted in blue right here. And I also track and disclose my portfolio value and my monthly YouTube income, and this is tracked every single month. So I believe, about next week we'll be updating these charts. And then these are my top 5 investing goals for 2021. So far we're on track to hit all of these, so let's see if we end up doing that. And then there's my 2021 stock market prediction that I put on January 1st at the beginning of the year. So let's see how close I end up getting. But one of my goals, as you noticed, was to get 150 referrals to M1 Finance. And if we go to this tab here and we click Refer and Earn, you will notice that we have 103 different people signed up. This link is down below in the description. All you got to do is download this link and deposit some money to the platform. If you deposit $100, you get $10 in referral bonuses. If you deposit $1,000, you get $30, so triple that amount. So either way, whether you're wanting to deposit $100 or $1,000, you still get all the great, awesome features that M1 Finance has to offer with invest, spend, borrow, research, and transfers tabs. This company has so many features that are absolutely free, no fees whatsoever. And if you want to see my pie firsthand, you can invest in it yourself. If you want any help getting started investing, there are mentoring calls down below. That's part of what funds my growth for this channel, but also help get you guys started if you're not familiar with the stock market or dividend investing. There's also things as well, including audit savings accounts, which put you in a lottery for savings accounts, credit card referrals, all that stuff. So check out the description, lots of things alike. So if you want to check out any of that, it's all very helpful. But let's go ahead and jump into JP Morgan stock. And I made a couple videos about this company back in 2020, and I told you why I was so bullish on this stock. Because JP Morgan, it's a boring old school bank stock. But one of the best parts about this company is that they do one thing arguably better than any other company on earth, being an old boring bank stock, is that they find ways to return capital to shareholders. The profitability of this firm is ridiculous. And we will go over that in just a second, but I want to talk about the news, why it's up again today, and why it's been up pretty much all this week because of the news that was just announced. The Fed announced that bank stocks rise after hours as Fed sets date to lift buyback and dividend restrictions. And this is a CNBC article that was posted just a couple days ago. And if we scroll down here, I've highlighted this one little comment section, this one little paragraph. The Fed said it would keep its pandemic-era restrictions on banks in place until June 30th. The Fed had previously said that banks could restart their buybacks and dividend hikes in the first quarter. So Thursday's announcement is a delay but does provide more clarity for investors. So basically, all these restrictions that the Fed has been putting on these bank stocks. So think of your big names like your JP Morgan, your Bank of Americas, your Wells Fargo, your Goldman Sachs. All these companies have had these restrictions, right? They haven't been able to pay dividends. Some companies, like your Wells Fargo, have had to dramatically cut their dividend. Let's go to the 2-year chart on Wells Fargo. They ended up paying 51 cents every single quarter back in 2019 and early 2020. They ended up getting cut to 10 cents. So that's like an 80% downturn. Now, the good news is JP Morgan was able to maintain paying that dividend all throughout 2020. They never held up. They kept on raising it, and as they got to 2020, they kept that payout of 90 cents a quarter every single quarter. But in that meantime, as the company went down in share price, most of their restrictions, or I should say pretty much all of their restrictions for share buybacks, were pretty much put to a halt. The Fed did not allow any share buybacks, and that allowed them to have more capital on the side to be prepared if things got a lot worse with the economy, with the pandemic that happened in 2020. But if we go to this year chart here, you've noticed that since November, this company has just been up and up and up and away. And part of that is because of the restrictions that the Fed had initially put on are starting to come off. Now, before we go any further, I want to talk about the profit margins of this company. Okay, so I'm going to show you a picture right now, and this is going to be showing you the profit margins of some of the top companies in the world. The companies listed here are including some that I own. I think there's 3 or 4 here that I own. There's Visa, JP Morgan, Microsoft, Nvidia, EA Sports, Goldman Sachs, another banking stock, Pepsi, Amazon, Walmart, and Tesla. And you can see the differences between these companies, okay? And what it shows is the revenue that the companies make, their gross margin percentages, and then more importantly, the number that is on the right, the kind of lighter blue colored, the right number that's on the side, and that is their profit margin. And I'll go ahead and just give you a quick rundown of the difference. Basically, gross margin is what is left after cost of goods sold. So basically, if I have a soda can, and I made my own brand of soda, and I sold it for $2, okay? And my cost of goods sold on that can of soda was $1. My gross margin would be 50% because it would cost me 50% in cost of goods sold to make it, and then 50% would be in profit. But if we were to take profit margin, it takes more things into account. What if that same dollar that it cost me in cost of goods sold, let's say it costs 50 cents worth of labor for someone to put together that can of soda, and another 20 cents or whatever for rent for the building that I build the soda in, whatever. And let's say after all that was said and done, that I had, let's say, 20 cents. Then that would have a profit margin of 10%. You see what I'm saying? So for every soda that I sold, I would really only have 20 cents on the bottom line profit numbers, right? After everything, insurance, labor, things like that. So really my profit margin would be 10% because $2 I would sell it and then 20 cents I would keep. And if you notice on this chart, the 2 big names on this chart are Visa and JP Morgan. And it's really interesting to see because a company like Visa is one of my largest holdings. If we go back here and we go to my portfolio, let's go to my main portfolio and let's go to Visa. It is 6% of my portfolio. I actually have a larger position built in Visa than I do in JP Morgan Chase. And one of the main reasons is because of its profits margins. Visa is able to keep 48 cents for every dollar of revenue it creates. Think about what I just said for a second. For every dollar that Visa creates, it keeps 48 cents of that roughly in profit. So if they produce $10 billion in revenue, then that means that they're going to keep about $4.8 billion in profit. Those numbers are astounding. And if you look at this chart, let's compare it to like a big name one that everybody knows and loves. Let's compare that to something like an Amazon or a Walmart. Walmart is in a very competitive space. The grocery industry is just so competitive. It is so cutthroat with your big names like Aldi's and Target and Kroger and all different types of grocery stores and things alike. It is so competitive that the margins are razor thin. And a lot of times on a lot of their groceries and basic items, sometimes their margins are even under 1% on their profit margin side. So if you look at 3% being the average for Walmart, they only make about 3 cents for every dollar of revenue that they have. So if they make the same example, $10 billion in revenue, then guys, they're not even going to keep $1 billion in that. They're only going to keep about 300 million. So very low margins, and the same thing for a big high growth company like an Amazon. There's such high demand for their products that they can't operate at scale, and that does mean that they do produce massive profits, but the margins are very low. Now let's go to JP Morgan, which is the focus of this video. For every dollar of revenue that they produce, about 42% goes to profit. That's their profit margin. That is extremely high. And if you even compare it to some of the biggest names out there, many of the ones listed on this chart, it beats all of those companies out. It beats Microsoft, Nvidia, EA Sports, Goldman Sachs, Pepsi, which is another company that I own, Amazon, Walmart, Tesla, many big names there. And this is why it's so important to look at a company like JP Morgan. Because no matter where interest rates go, no matter what the economy does, this company is just it's pretty much always going to be profitable. The long-term outlook on this company says profits. Now they might be higher, they might be a bit lower, but if you look at these margins and if you look at the growth trend that JP Morgan has had over time, if you factor in that they're buying back $1 billion of stock, issuing billions of dollars in dividends, which we're about to get to in a second, and you factor in the fact that they're still operating at a 42% profit margin in a world where interest rates are literally 0%, that bodes a lot well for JP Morgan. And you know, higher interest rates are usually good for a financials company like a JP Morgan. So don't be surprised if interest rates were to get much higher if this company were to start operating, as crazy as it sounds, at 50% operating margins, maybe even higher than what Visa is doing. So that is craziness, and that is just one of the more reasons why I'm so bullish on JP Morgan, because their margins are just ridiculous. Now let's go ahead and go to the CNBC article here. It says that the Fed allows banks to resume share buybacks. JP Morgan stock jumps 5%. Now this was a couple months ago, and I covered this article back in December. And I wanted to talk about how it relates to today. If we go to their chart, let's go ahead and pull up JPM's chart. You notice that if you go to January and December when this was announced, the stock has pretty much just been rapidly in an upward movement. So they announced it. What was that article posted? Let's go ahead and check. So it was December 18th. So it was announced right about here where my mouse is hovering. Now you notice right after they announced it, there was that initial pop. It rose a couple percent, and it's pretty much just uptrended ever since. And do you notice at the turn of the year, once it hit January right here, this was the first trading day, have you noticed a difference in the stock? Ever since January hit, which is right at this mouse. So let's look at this period after. Actually, let's look at the 3-month chart. So that goes right back to January. Yeah. So this is the 3-month chart right at the beginning of the year. Do you notice something in this chart? It's been green day after green day after green day. And do you want to know who's mostly been buying the stock? JP Morgan itself. And that's because the plan that they announced is that they're buying back $30 billion. JP Morgan Chase, the largest U.S. bank by assets, announced in the minutes after the Fed test results that its board had approved a new share repurchase program of $30 billion starting in 2021. Many companies, when they buy back their own shares, are looking at buying just fractions of what the company's worth. Just slowly over time, hopefully it'll make a difference. This company, $30 billion, and that's even after the rise in share price, was looking at buying back about 10% of its market cap from when they announced it. This company was about $300 billion, a little over that. They're looking at buying back about 10% of the entire company's market cap. You don't have to do any work for that. You just wait. You just sit and own it. And that doesn't even factor in the massive dividend yield. I told you guys I own this company at about a $98 a share. So let's go ahead and look at my cost basis. What do I own this company at? Was it 98? Let's see, JP Morgan right here. Yeah, I own it at $98 a share. So I own this company at almost a 4% dividend yield. So this company, while I own it, all I have to do is sit and wait. It has went up in share price, and I believe that will continue. In the meantime, they will buy back about 10% of this company's market cap as it was announced. This company will pay me almost a 4% dividend yield to own it, which will likely go up over time. June 30th, like they said, those restrictions come off. I expect them to raise that dividend, so my yield on cost will probably be 4% or even higher in the coming years. And in the meantime, the company will grow. They will expand into new customers. They will become more profitable. Interest rates will eventually go higher, so that just means more money on the cash that they have on hand in their long-term bond purchases. And this just makes this company an awesome opportunity. It's 50% higher from where I own it at, and I'm still buying this company. And last but not least, I want to go over this article. We have yet another CNBC article, I know. And I want to talk about the competitors in this space. Because one of the main ways that JP Morgan could really start to feel some pain is these fintech companies. It's one of the main risks for this company. If a lot of your big competitors, like your PayPal and your Squares and your whatever, if a lot of these fintech companies offer customers these awesome, sweet deals to acquire as many customers as possible, and they take on the new age groups like me, the millennials, the Gen Z people. If they start attracting those customers and then long-term become profitable with them, they could really start to hurt companies like a JP Morgan Chase. And one of the things I notice about this is that when I look at the other big banks, when I look at your Bank of America, when I look at your Goldman Sachs, God forbid if I look at your Wells Fargo, who have just made horrible choices, when I look at JP Morgan, they're the most adaptive to its environment. And it's because of articles like this that makes me convinced that JP Morgan will not only survive, but thrive throughout these fintechs becoming larger and larger. JP Morgan Chase takes on Square and PayPal with smartphone card reader, faster deposits for merchants. I highlighted 2 paragraphs here that I want to read real quick. Their fast funding is offered free, unlike competitors including Square, which typically take a day or 2 or more and charge a 1.5% fee to make instant transfers to external accounts. Our competition either doesn't have same-day funding or they charge for it. CEO of JP Morgan's Merchant Services arm said in an interview, "We think it is a great differentiator for businesses because getting money into their account quickly is so important as they manage their cash flow." One of the great things about JP Morgan is that they already have such a large network of clients that they don't really have to focus so much on acquiring new customers. Many of its small businesses already use JP Morgan because they have such a vast amount of resources. So now that they offer a free service, what competitive edge does a PayPal or a Square have that JP Morgan doesn't? They probably already have their checking and savings accounts and business accounts, or maybe even business credit cards or loans or whatever. They probably already have a lot of that with Chase. So what is their incentive to go with something like a Square or a PayPal when JP Morgan can offer them the same or even a better service? This is why I'm not really too worried about JP Morgan surviving, while a lot of your old school companies that aren't making these innovative moves, like your Wells Fargo and your Bank of Americas, they may not thrive over the next decade, but I believe JP Morgan will. So all these reasons are why I love JP Morgan Chase. They are massively dominant in the financial sector. They are the largest bank in the world. They have innovative products that are competing with a lot of these newer fintech companies. Their CEO, Jamie Dimon, is incredible. He is very conservative, very intelligent, very wise, and very long-term focused, which sometimes with CEOs you don't get that. You get that with JP Morgan CEO, Jamie Dimon. And then more importantly, this company does $30 billion in share buybacks, buys back billions of dollars of its stock while paying back dividends, and this company's profitability metrics, its cash on hand, and another thing too that I just didn't mention. I mentioned this before. When you think about a big bank, like especially JP Morgan, the largest one on earth, if there was ever some type of horrible recession, like what happened in 2009, right? Do you think that the Fed would ever let a company like JP Morgan go under? I really don't think so. I think that they would do everything in their power to keep the banks up because the banks are our front lines. If the banks go down, then really our economy's shot. So really, if any company was to be last to go bankrupt, JP Morgan would be one of the last companies to go bankrupt, and that just gives me one more reason to own it. But thank you guys so much for watching all the way to the end. I really appreciate it. If you enjoyed this video, I'd invite you to subscribe. Go ahead and get signed up and get that free referral money like we spoke about. But otherwise, guys, I appreciate the support, and I'll see you guys next time.